this webinar. So if you have to log off, pop out, don't worry, it won't be an issue. You'll be able to watch the replay at a later date. We will have it posted to our website, hopefully later today, if not by tomorrow morning. Second thing is, I know we're going to get this question later, but we're going to tell you now anyway. So hopefully those of you that are paying attention, remember, yes, we will send the slides out. Those of you that are on the webinar live, you will receive the slide deck. So don't worry, you don't need to ask for it. It will come your way. The last thing that I'll highlight with regards to the presentation is we are going to host a Q&A session at the end of the presentation. So hopefully you all by now are familiar with Zoom and the taskbar, but there is a Q&A section in the taskbar. Feel free to go ahead and lob in any questions that that you'd like to have answered. Kitty Harding, one of my colleagues, will kind of manage that Q&A, so she'll pull all those questions together and try to identify what's most relevant and most helpful to everybody on the webinar. If we don't get to your question, my apologies, but feel free to email us. The easy way is information@larcanalytics.com. That's LARC analytics.com. But if you want, you can also email me directly at ryan.melliker@larcanalytics.com. And the last thing I'd say before I get started is I'd be remiss if I didn't just acknowledge that today is September 11th. We lost a lot of great Americans 24 years ago when the state, being a New Yorker, it's pretty relevant for me. So I just wanted to say that my head and my heart is out to all those families and friends who lost loved ones 24 years ago today. But we all have to move on, and that's exactly what we're going to do here. So we're going to jump into the presentation now. And hopefully there's a lot to cover, so hopefully you all find it interesting and are able to stick around. Before we jump in, on a side note, I'd just like to say, we're really proud of the work that we do here at LARC. And it seems like we're gaining more and more traction every quarter. These webinars, which we do for the industry in general, seem to get more and more traction. I think we had over 800 people register this quarter, which is by far the most. So thank you all for the support. We appreciate it. That being said, this is our agenda for today. We're going to spend a little bit of time talking about kind of where the industry's been over the last few quarters. And then we're going to spend a lot of time talking about the economic outlook and the implications on the hotel industry. I should be clear and upfront that it is not a robust economic outlook right now. The outlook certainly over the next few months, few quarters is pretty cautious. There are pockets of things to be excited about, and we'll try to highlight them. But generally speaking, it is not an overly robust economic outlook that is driving our forecasts. Then we'll jump into what the actual forecasts are relative to that economic outlook that drives them, and then we'll jump into the market highlights. So with that being said, let's jump into that industry review. So if you look at the past few quarters of performance, which is what you see here, you've got the last 6 quarters of supply demand, OC, ADR, and RevPAR for performance across the U.S. Couple things that we think are really worth highlighting is that number one, demand growth has turned negative. Number two is occupancy growth has now been negative in 3 of the last 5 quarters. And then the third thing I would highlight is that ADR growth has been muted. We have not seen more than 2% ADR growth in any quarter of the last 6 quarters. And as a result, RevPAR growth was negative for the first quarter in a while in the second quarter of this year. 1Q last year was really soft, but that was partly tied to the Easter calendar shift. 2Q, again, there was an Easter calendar shift, so that had some component, but it's also the macro backdrop. And as it pertains to that macro backdrop, one of the things that we'd highlight is that the 2Q GDP print was actually quite strong from a headline perspective, a little over 3% GDP growth. That's great from a headline perspective. But if you dig into that GDP number, and the Wall Street Journal put out a great piece about it kind of right after the print occurred, they kind of highlighted that if you back out the net trade imbalance, which can be a volatile component of GDP, but especially during periods of uncertain tariffs, like we've been in the past few months, you can see big swings in GDP growth tied to that. We saw that net trade imbalance as a big headwind in the first quarter, and then as a big tailwind in the second quarter. If you just backed that out, GDP growth actually was -2% in the second quarter. So much, much softer underlying economic activity than that headline GDP print suggests. And that's part of what you see in that declining demand, declining occupancy, muted ADR, and declining RevPAR metric from the second quarter. Now, we're going to talk a lot about the US as a whole during this presentation, but I think you all know that every market is different. And you have to understand what's going on in your individual markets, because while we're going to talk about the US as a whole, there is wide divergence from one market to another. I mean, if you look at the top chart here in 2024 alone, we saw a market like Houston that saw 15% RevPAR growth, and then a market like Maui that was down 10%. 25 percentage point swing. And yes, that's extreme, but we still see really wide swings in 2025. Markets like San Francisco and Palm Beach are pushing 10% growth, while Memphis and Houston are down close to 10% for 2025. So again, you're seeing really, really big swings. Not every market is the same. And you have to understand your market, understand what's driving those individual markets, and take the national views, and they can give you some insight and some benchmarks. But at the end of the day, if you don't know what's going on across the markets you're focused on, the national data isn't going to be that. So we always highlight that because I think it's really, really important, this divergence across markets. That being said, if we get back to the national data, I'm looking on the top line and looking at the bottom line. What we generally see is 2024, obviously, we saw muted RevPAR growth, which translated into slightly negative hotel EBITDA across the country based on our metrics. In the first quarter, EBITDA was slightly positive. Again, we had some tailwinds tied to the Easter calendar shift in the first quarter. RevPAR growth was a little bit better, and so was ADR, a little bit better than 2024 levels. And we started to normalize some of those elevated wage gains, et cetera, for the first quarter. But then the second quarter, we saw a big drop off in EBITDA, which was down 3%. And we'll talk a little bit what that means to hotel values as we go through this year and beyond. But in 2024, we felt like values actually were relatively resilient and even somewhat strong, as there was a lot of optimism for the future at the end of 2024. Optimism has since dissipated pretty meaningfully based on hotel performance to date. Now let's jump into that economic outlook that I talked about. And what I really want to talk about when we talk about the economic outlook is the current administration's impact on that. And I refer to it as Trump's unique brand of chaos. And it's just led to heightened uncertainty regarding policy, especially tied to the economy. We all know the tariffs are tremendously uncertain. We could talk about that until we're blue in the face. I think at this point, that's pretty well understood. But there are other factors beyond if, how, and when the tariffs will take effect, which we still don't know, with the Supreme Court agreeing to hear a case on the tariffs in November. So maybe we get some resolution in early 2025, 2026 on the tariffs, but there's a lot of uncertainty tied to them. There's also uncertainty tied to what these government cutbacks are ultimately going to stabilize at. We've obviously been seeing heavy government cutbacks in spending. We're seeing massive funding cutbacks to universities and healthcare systems, research grants, et cetera, which is having a really big impact on a handful of markets where that we've got major universities that are big drivers of performance, and then and the local economy. Then we have the immigration policy, where not only are we dealing with border control issues and visa restrictions, but we also are seeing the ICE raids and the use of federal troops inside the United States against the will of local politicians, which is a first. So there's a lot of uncertainty tied to all of those things. You then layer in, what could be coming that hasn't occurred yet. First, Federal Reserve independence is now being brought into question. Obviously, Trump has been pretty vocal about Chairman Powell and his, wanting to ouster him, but that hasn't happened. Instead, he's tried to ouster one of the Federal Reserve governors. Lawsuit has been filed, and she is still in place until that lawsuit is resolved. But there's a lot of concern there. Well, is the Federal Reserve going to stay apolitical or become a political entity? And then there's the economic data integrity question. As many of you are probably aware, in following July's Bureau of Labor Statistics jobs report, the Trump administration decided to terminate the head of the BLS. Now, obviously, there you can make the argument, oh, he didn't like the numbers, and that was why he decided to terminate her. Up for debate. I think there's the other side of that argument could be, well, there's been a ton of revisions, and maybe the approach to getting that data needs to be totally revamped, and that wasn't the person to do it. You could play either side of that argument. I'm not going to play either one, but regardless, there's a question about the data integrity, right? And can we really rely on this data like we have in the past? Because I can tell you, one of the bellwethers of the U.S. is our economic data and the reliability and dependability that investors have on that. It's one of the reasons why the U.S. dollar is the backbone of so many currencies across the world. People don't trust the GDP results coming out of China, right? That's just a reality. The economic data feels like it's manipulated across many countries, but the U.S. has had that integrity, which is really important in my view, and that has translated into what it is ultimately a very positive thing for the U.S. economic backdrop. The last thing that I'll highlight that I think is really important is there is tremendous risk of a federal government shutdown in the coming months. The current fiscal year is funded, which is great, except it ends at the end of this month. And only 3 of the required 12 resolutions fund the next fiscal year have been approved by Congress. The reality is, to fund the government, we need the House and the Senate to both approve those resolutions. There might be some continuing resolutions to kick the can down the road, and maybe it's not that the federal government gets shut down October 1st because there's a lack of funding, but there's a lot of risk and uncertainty tied to it, and as it continues to kick the can down the road, it will continue to weigh on economic growth across the country in general. And the reality is, when we think about the federal government shutdown, is the Republican Party is on 2 sides of the spectrum, let alone the Democrats that we know aren't going to do anything to help the Republicans. You have 2 sides of the Republican Party, one that wants spending cuts and one that wants to fund Trump's priorities. And those 2 things don't go together, and it's just going to be really, really hard, and that's why things haven't moved forward, and there's not a lot of confidence that it will anytime soon. So that's another big risk. So again, like I said, I prefaced up front that there's a lot of negativity tied to the economic outlook. We're going to highlight some positives, don't get me wrong, but I just want everybody to we're trying to be clear about kind of the backdrop that frames our views for the hotel industry. We know about the tariff uncertainty. Here's just a simple timeline of the craziness that has happened in, related to Mexico and Canada tariffs. Obviously, this is the case for just about every country, but you could see basically every other week you were seeing a massive change to the what was happening for these tariffs. And the challenge with this uncertainty tied to the tariffs and economic policy in general is whenever you have uncertainty like this, companies and consumers don't know what to do, so they stop doing anything. Daryl Cronk from Tourism Economics made the analogy that I'm going to steal because I really, really liked it. It's like being a football coach. Every company CEO is a football coach, except the rules of the game are changing. So you went into the game thinking, okay, I've got 4 downs to get 10 yards and get another first down. And then, okay, we're going to change it to, instead of 4 downs, it's 2 downs. And now instead of 10 yards for a first down, it's 25 yards for a first down. And oh, wait a minute, if I wait 10 minutes, it's going to change again. What's it going to be then? And how can I call a play if I don't know whether I have 4 chances to get 10 yards, I have 2 chances to get 10 yards, or I need to get 25 yards? So I'm just going to wait and see where things settle out and not call anything. And that's what is happening across the business community. and the consumer to an extent. There's been stagnation, plain and simple. And that stagnation, is tied to all of this uncertainty. That uncertainty is very, very real. We just talked about the idea that, okay, maybe there will be some resolution to the tariffs by early next year, but until then, we just don't know. Good news is maybe we're getting a little numb to it, and that could help. Bad news is it isn't helping yet. If you look at the jobs data that was released just last week on Friday through August, um, it paints a pretty dire picture. So since March, 6 months, past 6 months, if you exclude the healthcare sector, employment levels have declined. If you look at the past 3 months, excluding the healthcare sector, employment levels are down 86,000 jobs. And over the past 3 months or 6 months, over the past 3 months and 6 months, we are looking at sectors that have declined in job growth of roughly half of all the sectors, a little bit over half. To give you an idea, every time that's happened since the BLS started tracking this data, we are, since 1972, I believe is when it started tracking this data. Every time we've seen 6 months of declines of at least half the sectors, we've been in a recession or heading into a recession. And there's been zero false positives. That shouldn't make anybody feel great, right? However, while that's obviously a concern, only 33% of economists surveyed by the Wall Street Journal are forecasting a recession over the next 12 months. And Moody's, who is the economist we rely on, who admittedly is probably a little more conservative, only applies a 50-50 chance of us falling into a recession over the next 12 months. So how do those two things go together? Because at the end of the day, what's happening with job growth is if jobs are declining, and we're seeing those dynamics, that what does that do? It does a couple of different things. Number one is, from a consumer perspective, you don't have as much power. Wage growth tends to slow in a softer job market. Number two is fewer people are employed, which means they have less disposable income. So that impacts leisure travel, right? And from a corporate perspective, if companies aren't growing and hiring and spending, they're not spending on travel either. So all of those things play a role. So why are we not seeing a recession coming? Or why are the economists not forecasting it? There's two reasons. Number one is, a lot of this uncertainty is tied to the tariffs. If the tariff resolution materializes, which it can in the next few months, you could see this switch in a heartbeat, right? People starting to feel more confident. I have more confidence and I can move forward. And that's what we're going to see and that's what we could see from a corporate perspective. And then things start to turn much more positively, right? We can totally see that play out. The other side of things that I think is also important over the next 12 months is we have this thing called the Big Beautiful Bill that was passed. And believe it or not, that's going to create a fair number of tailwinds to economic growth in the back half of 2026. So if we can get to the back half of 2026 without seeing a recession, it seems unlikely that we're going to. So there are so like I say, there are challenges in the near term. There's upside. There are opportunities as well. I know I may come off as, overly negative or cautious tied to the administration's policies. That's not what I'm trying to do. I'm trying to highlight the implications of them for our hotel industry, which is very, very real. Some of them are positive, some of them are negative, and that's what we're focused on here. And I think that, if you take an objective view, you can see some of that. Other things related to these tariffs and the uncertainty, business investment and corporate profits are projected to decline going forward. That's not great. When companies aren't investing, they tend not to be traveling. When profits are declining, they tend to be focused on cutting costs rather than spending money on corporate travel to try to grow sales. And that's what you see coming up in the next few quarters. which obviously is somewhat concerning. Just to give you an idea, if you look back, if you look historically, the relationship between business investment and RevPAR growth on a seasonally adjusted basis, there's an 86% correlation, a 73% R squared. So it's very relevant. Same thing, corporate profits not quite as strong, but also very relevant, 76% correlation, 58% R squared. Other side of things is consumer sentiment and the impact that the tariffs and the uncertainty surrounding the tariffs have had on that. I'm not sure how many of you are aware, but in May, the consumer sentiment index reached a low of 53.6. It was the lowest level in 45 years. That's not very good for summer leisure travel when you think about plans being booked into the summer in May. And we certainly have felt it over the past few months with leisure travel being really soft, negative RevPAR growth in June, July, and August, right? Certainly playing out. Good news is consumer sentiment has bounced off of that trough, but we're still at pretty low. So, I think that things have bounced. Long way to go, though. And that helps explain what we saw over the course of the summer. Other thing I would highlight is rhetoric and policy tied to foreign travel. Just to give you all some perspective, there's a lot of headlines out there in the media where they'll take something that Trump or the State Department is doing and run with it. You have to kind of dig under it to see what's really going on. Last month, there was a lot of talk about the State Department requiring a $15,000 visa bond for foreigners that require visas to come to the U.S. That sounds striking, right? To get a visa, you got to pony up 15 grand. How many people are willing to do that? Not a lot, is my guess. Well, guess what? When you dig in, they've only made that requirement for citizens of Malawi and Zambia. Right? It's not a broad-based dynamic. So again, the media will take it and run with it. You have to look behind it and get into the details. Obviously, earlier in the summer, the Trump administration initiated a policy to restrict entry to the U.S. from 12 countries, including that they believed as terrorism concerns: Iran, Libya, Somalia, and others. Again, we're not talking, this isn't France, UK, Italy, China, Japan, Canada. These are much smaller components of our of the industry, but it still is having an impact. And on the flip side of that, for those of you that aren't aware, and I imagine most of you are, it's not just the actions that are being done, it's also the rhetoric. The fact that the administration came out talking about Canada should be the 51st state. If I were Canadian, I'd be pretty pissed. If you're proud of where you're from and your country, that doesn't make you feel good at all. So what's happened? The Canadians elected not to travel to the U.S. because they don't want to spend their money here and support our economy. And that's exactly what has happened. Canadian travel is down massively this year, and that's weighing on performance as well. And to give you an idea, it's obviously not just Canadian travel. Foreign travel dynamic is a huge issue for our industry today. So if you look at international inbound arrivals, last year in 2024, traveler volumes were up 8%, or up 9% year over year. And they were 8% below 2019 levels. Why had they not recovered to 2019 levels? I think there's two reasons for that. One is a lot of those foreign economies didn't recover out of the pandemic as quickly as the US. And two is the dollar was at all-time highs, making it an expensive trip for a lot of foreigners. All right. On the flip side, international outbound travel last year saw volumes also up 8% year over year, but that was 21% above pre-pandemic levels. So you had seen this strong growth for US citizens traveling abroad. Now, if we shift gears to 2025, we've done a full 180 in foreign inbound arrivals. Over the past the 7 months through July, first 7 months of the year, we went from plus 9% year over year in 2024 to down 4% year over year through the first 7 months of this year. And outbound travel from the US has slowed, but the trends have held up. We're up 3% year over that same period. Now, here's the rub. If you go back to 2019, net, there were 4 million more foreign travelers coming to the U.S. than U.S. citizens traveling abroad. On a trailing 12 months as of July, there were 16 million more travelers going abroad than coming to the US. That is a swing of 20 million travelers. And obviously foreign travel, overseas travel has a longer length of stay. You just assume a 4-night length of stay, which I think is conservative. 4 nights times 20 million travelers, 80 million. That's 80 million room nights lost since 2019. That equates to, roughly 6% of overall demand. That's a big number, and so we need to address that. Easier said than done, but pretty hopeful. And then, when you think about certain markets are going to be more impacted than others by this challenge, right? It's going to be the gateway cities that have a lot more exposure to foreign travel that we're seeing this big headwind for. Some of them are making up for it through other means, others are not. But you can see kind of who has the most exposure and who has the least exposure on this chart here. And just because you have the most exposure doesn't mean you haven't recovered. You've actually seen Dallas bounce back pretty nicely. Seattle's done really well. DC, it's a little bit more stable because it's so government related. But then you look at Honolulu, which is still 45% below 2019 levels. Detroit, LA, Chicago, all down pretty meaningfully relative to pre-pandemic levels. And that weighs on these markets' performance without a doubt. So good news is there's upside. Bad news is, we don't know when that's coming, although we have some optimism for next year. Then we'll talk about immigration. The reality of immigration is when we're pulling as many undocumented workers out of the country as we are, and I'm not going to try to politicize whether it's right or wrong to be doing what is being done. What I will say is that when you pull people out, those people were spending, and if there are fewer of them, there is less spending, and that impacts economic growth and economic activity. And that's exactly what we're seeing. At least we're seeing that in the near term, where you're seeing fewer people crossing the border, and you're seeing and we've seen an increase in deportations. Now, it's outside of the impact that has on economic growth. It also has an impact on, the employment and challenges that we think hotels and construction companies are going to find in the coming years, tied to especially those states where there's a lot of undocumented workers, California, Florida, Texas, where the undocumented workers are no longer there. Therefore, it's harder to find labor. That's typically skewed to construction and hospitality. Even if you're a large hotel company, you may not have undocumented workers, but I bet you there's a lot of them in your market if you're in those states. And in that case, it's going to tighten that labor pool, which is going to make it harder. Harder to hire, harder to maintain staff, and wages can potentially go up. So just things to keep in mind from all of this. And then there's the federal dynamic that we'll highlight. So obviously, government-rated business has dropped dramatically this year. Somewhere in the ballpark of 15% of all federal workers have been laid off. Those federal workers that have held on generally have seen their spending reduced dramatically. That may be a good thing for the country over the long term, but it's not great for the hotel industry, right? Where you've got government travel that is a big component of overall demand for the hotel sector. So that's weighing on things. The other thing that we'll highlight is this return to office dynamic for DC. People ask the question to me all the time, well, isn't DC doing better since they require everybody to come back to the office? And the answer in short is, well, people aren't really back in the office. So just about every federal union has filed suit blocking the return to office mandate, because ultimately they all have language in their collective bargaining agreements that enable telework flexibility, making it really hard. On top of that, DOGE cut 750 office leases with 10 million square feet of office space. So even if people wanted to come back into the office, in many cases, they have nowhere to go. So, we see these headlines, but looking past the headlines is what's really important. And the reality is we're not seeing that big return to office for the federal, for federal employees, but government, business for hotels has really softened. And it doesn't look like it's going to turn around and get better anytime soon. it's kind of being reset in a new normal for an extended period of time, at least through the current administration. Um, and when we think about return to office and go beyond the government, just look at broader return to office. Um, we continue to see headlines that things are coming back. Why do we care about things coming back, return to office? Well, people are in the office more. There's more, you want to travel to see them in the office. More salespeople want to go see them. You want to go visit clients, those types of things. They're in the office less, you have less need to do that. The reality is, since the pandemic, we have seen a big reduction in office utilization levels. People just aren't in the office as much. And what that has translated into is a shorter length of stay for trips for a couple of years now. Airlines have been back to, pre-pandemic corporate demand levels, but hotels still have not reached that because people are doing more out and back stay trips on the same day rather than staying overnight because they only have enough meetings for one day because people aren't in the office the second day. Or if they're doing what would have normally been a 2-day trip is now a 1-day trip. What would have normally been a 3-night trip is now a 2-night trip because there aren't enough people in the office. Plain and simple for you to justify staying that extra night for those meetings. So while the headlines look good that this is going to get better, and that's encouraging, the challenge is the data doesn't necessarily support it. So Castle Systems is who we track on a regular basis. It's not the end all be all, but it's a great indicator of whether things are moving one way or another. Their Castle Systems basically is the card swipe company. So people that are going into basically Class A office buildings and where there's real security. And it's been hovering for 2 years now at about the same level, just above 50% across most major markets. In fact, if you look at just the past couple of months, we've still been there, just above 50% on average, right? So no meaningful move. And they're not the only ones suggesting that. We look at the Flex Index. The Flex Index is an interesting publication where they actually survey 100,000 office locations and get a sense of what's required across those office locations. And a year ago, those office locations were requiring employees to be in the office on average 2.49 days per week, 2.5 days per week. By year end 2024, that jumped to 2.82. So there was some real growth, and that was encouraging. But in the first half of this year, that 2.82 only climbed to 2.87. So we've seen that materially slow, kind of stabilizing as it approaches 3 days per week, which we think is going to be the realistic metric. And that just doesn't lead to more growth in office utilization. And we talked about why that matters. On top of that, think about the industries that have the most flexibility: tech, insurance, professional services, financial services, right? These are the sectors that drive corporate transient demand for the hotel industry. So when you think about it from that perspective, that's not very encouraging either. It's something that we have to be mindful of from a corporate transient perspective. Now, let's give you some good news, right? Geez. So group continues to be strong. I know there is some softness here and there, and we have seen a little bit of attrition from a group perspective, but the bookings are still there, and we still feel really good. Convention bookings, we track the 30 largest convention centers across the U.S., and you see 2025 booking paces 4% above 2024 levels. So it's held relatively stable over the past few months, even though we've seen some near-term attrition. More importantly, the booking pace for 2026 has picked up. It's now up 7% year over year across those 30 convention centers. So that's encouraging that we're going to see that group dynamic unfold. Obviously, attrition is a risk where that can come down, but right now we feel pretty good about what we're seeing from a group perspective. Some markets will outperform others. You see the markets with the strongest growth there as well this year, and then the ones with the weakest in terms of year-over-year convention booking paces. I think that's really important. Next, we'll highlight, some of the challenges tied to the consumer, which leads to leisure. Retail sales growth is slowed. We talked about consumer sentiment earlier. None of this should be too surprising to anybody. Retail sales have definitely softened. The Visa Spending Index, has improved from where it was earlier this summer and is ticking back up a little bit better than what it was, but we're still in contraction territory. Anything below 100 is contraction. So we've been in contraction for the last year and a half or so, and that looks like getting closer and closer, and that's encouraging. Makes us feel okay. And the same thing with the Deloitte Spending Intentions Index. Overall total spending is still in contraction territory, but it has ticked up off of those lows a few months ago, which is encouraging. Leisure demand, has bounced back from that low. It's still relatively soft, but improving. Um, and when you put all that together, you get kind of the backdrop for the macro environment that shapes our U.S. outlook. Um, so if you think about the factors that really drive corporate demand, real GDP growth is expected to be anemic, really over the next 6 quarters or so before it picks up in 2027. Jobs growth, virtually no job growth going forward, really through 2027 in the current environment. Unemployment rate is going to tick up. Corporate profits are declining this year, declining next year before they turn positive in 2025 or 2027. So the factors that drive a lot of our corporate demand metrics are really soft. That's not encouraging. From a leisure perspective, consumer confidence is expected to continue to decline into the middle of next year before it turns positive. Turning positive is a good thing. We want that to happen. So we see challenges from a leisure perspective, through then. And then you layer in CPI, and CPI is expected to pick up, accelerate to over 3%. You guys probably all saw the inflation print this morning, which was elevated, but not so elevated to, make, convince the world that the Fed's not going to cut interest rates, but elevated enough that it could turn into a risk in terms of impacting disposable income for leisure travelers. Bright side of that is higher CPI growth usually translates into consumers accepting inflation a little bit more, and then you can push ADR a little more aggressively across the hotel industry. And then there's the dollar. The dollar is expected has fallen precipitously year to date and is expected to continue to decline through next year. And that should create tailwinds for inbound foreign travelers next year and headwinds for U.S. travelers choosing to grow abroad as the U.S. gets more affordable for foreign travelers and foreign destinations get more expensive for U.S. travelers. Now, the last thing I'll highlight about this table that I think is really important is look at that 10-year Treasury yield. You will notice that it is not really moving. But the Fed is expected to cut rates. Why is the 10-year Treasury yield not moving? Well, the Fed funds rate is a short-term interest rate. And long-term interest rates, like a 10-year Treasury yield or like a cap rate or a mortgage rate, are driven by a combination of a short-term interest rate and a risk premium over that time horizon. If the short-term interest rate is shrinking because economic growth is really soft, then the risk premium expands. So what you actually see is short-term interest rates declining, but long-term interest rates unchanged. And that's exactly what you're looking at here. And a lot of that is tied to a massive federal deficit that is only expanding, coupled with anemic economic growth over these next couple of years that will weigh on long-term interest rates. Now, I'd be remiss if I didn't highlight something that we try to highlight every quarter, which is that the relationship between RevPAR and GDP is broken down. Prior to the pandemic, there was about an 80% correlation between GDP growth and RevPAR growth. And since 2023, that's closer to negative 23% correlation. Why has that broken down? We think it's broken down because of two core components. Number one is that international travel shift that we've seen massively impact things, where you can see GDP growth, but the consumer is choosing to travel abroad rather than domestically. And number two is corporate travel is becoming a smaller component of broader demand mix. So when corporations are growing and things are going well, you are not seeing the impact on RevPAR growth because they're not traveling as much. It's a smaller component of the mix. Now, the assumptions that we have driving our forecast, Fed's going to cut rates later this month and do it again in the fourth quarter. Inflation is going to tick up into 2026 before it starts to moderate again. Our assumption on tariffs is that they'll stabilize around 15% by the end of 2025. Keep in mind that's a pretty big increase from where we were last year, but nowhere near kind of the high end of potential outcome scenarios. And we'll talk about that in a little bit. And then conflicts in the Ukraine and Middle East are not going to expand. And there's no near-term U.S. recession. Repeat, no near-term U.S. recession. but economic growth is going to be muted, and we could be looking at a quote jobs recession with jobs declining, but not economic growth declining, because we're seeing an increase in productivity tied to increased technology advancement, things like AI, et cetera, that will help companies drive stronger growth without having to hire. Now let's talk about the hotel industry, which is what you guys all really, really care about. From a corporate transient front, corporate transient demand is expected to moderate a little bit this year, kind of like we talked about. We think things will start to stabilize next year and ultimately stabilize around 10 percentage points below pre-pandemic levels. So we have seen that be the segment that is the loser coming out of the pandemic. Group we expect to continue to gradually increase through 2026 and into 2027 and stabilize roughly 5 to 10% above pre-pandemic levels. Leisure was the big winner immediately out of the pandemic. It really spiked in 2021 with all that revenge travel. It's been moderating ever since. We expect it to continue to moderate this year. But next year, we actually see leisure doing okay. And one of the big reasons for that is our view of foreign inbound travel to the US related to the World Cup, which we'll talk about in a little bit. Supply growth is incredibly muted, very, very benign. We do think things will pick up in the back half of this year and next year, but we're still only talking about 1% supply growth, which is which is half of long run averages, not a real concern. And then things are going to slow thereafter. That near term dynamic is really tied to properties under construction today. Net, what we'll highlight here is that of the 62 markets we issue quarterly reports on, there is not a single market that we don't like because of supply growth. There are markets where supply growth is a little bit elevated, like the ones we highlight on the slide. But generally speaking, if we don't like that market, it's not because of supply growth. Supply growth isn't so high in any given market that it scares us tremendously. There are pockets where it might be bothersome, and there are times a year or two where it might be soft. But generally speaking, supply growth is muted nationally and across just about every market. So we're not super concerned about it. This is our RevPAR forecast model. For those of you that have not seen our work in the past, the dark blue line that you see in this chart is actual RevPAR as reported by STR on a seasonally adjusted basis going back to 2000. The light blue line is the model that we have built to estimate that RevPAR historically, as well as going forward. That model, if you think about your stats class, got back in 2000, back in college, has an R squared of 98.8%. If you remember that stats class, that R squared effectively means that model has predicted 98.8% of all the variability of RevPAR historically. You can see the drivers of that model. They also include things like supply and convention pacing, in addition to these macroeconomic factors. But it gives you a sense of how accurate that model has been historically. That little bump you see right here is the World Cup. We'll talk about that shortly. ADR, same thing, 98.9% R squared. The variables are a little bit different. So then we'll get into our actual forecast, right? And this is our forecast versus the other guys for 25 and 26. What you will notice is that we are the most cautious at negative 0.7%. RevPAR growth, STR came out with an updated forecast last month at negative 0.1. We're a little bit worse than them, and we'll explain why in a second. For this year, what you will notice is conspicuously missing here is CBRE. We've normally included CBRE in this chart. Unfortunately, CBRE, we did not see a release from them for the latest forecast. And then last week, they laid off their hotels research team. So everybody on that team, we're thinking about you. Our hearts are with you, and hope everybody lands very well on their feet. But regardless, and as we look to 2026, our outlook is, I would say, middle of the road relative to a lot of these other guys. Not super bullish, not super bearish. We're a little bit more positive on ADR, but our occupancy level is the lowest across the sector. And I think that's generally how things have played out, where we're a little bit more cautious on occupancy than most others, and that has frankly proven to be more accurate. We tend to be a little bit more positive on ADR, and that is more accurate sometimes. Sometimes it's not. When we look at that forecast and drill it down on a quarter by quarter basis, our 3Q 2025 RevPAR outlook is -1%. That -1% is relatively consistent with what we've seen quarter to date. So we feel pretty confident that that number is going to be close to the actuals. 4Q is down 3.4%. So that's a big, big shift in softness. Why are we forecasting such a decline in 4Q? Well, look at 2024 4Q plus 3.7%, which was a big outlier last year. Why was 2024 4Q so strong? Well, you had a tremendous amount of displaced demand tied to two hurricanes in Texas and Southeast, Hurricane Berwin and Hurricane Milton. Um, as a result, we've got really difficult comps in the fourth quarter. We're not forecasting hurricanes in the fourth quarter this year to drive that level of displaced demand. And as a result, that weighs on performance in the fourth quarter of this year. Things, soft in the first quarter, but then we see things pick up in 2Q and 3Q. And why do things pick up in 2Q and 3Q? Well, we talked about some of the benefits. Economic growth will start to improve, tied to the tailwinds from the big, beautiful bill. But on top of that, you're also going to see impact from the World Cup, which we think is pretty positive in those quarters, isolated to a handful of markets. So when we think about that strength in the middle of 2026, we'll talk, it's market specific more than it is nationally, but it does impact the nation as a whole before things slow a little bit in the fourth quarter. But net, we've got 2026 RevPAR growth of 0.9%. What I can tell you is if we backed out the impact of the World Cup, that would probably be down about 1%. So it's about 2 percentage points of tailwind from the World Cup. That's only impacting certain markets. So if you're not going to be one of those markets, you run the challenge of, well, then it's not necessarily going to play out like you see on a national metric. So just something to highlight. When you think about kind of the breakdown by price class, luxury class has been the clear winner. We expect luxury to remain relatively strong in 2026, but we think upper upscale will do a little bit better. And that's tied to the strengthening group coupled with some of those World Cup dynamics that we think favor upper upscale a little bit more. But again, we generally favor the higher end chain scales to the lower end chain scales. That's been the case over the past couple of years, and we expect that to continue to be the case in 2026 as well. And then this quarter, we rolled out market segment forecasts: airport, interstate, resort, suburban, urban. We generally view for 2026, urban and suburban will be the winners. Airport will be really soft. Resort will be a little softer. Some of that is tied to this dynamic that a lot of the foreign inbound arrivals are going to be more tied to the urban locations for the World Cup than they will be to resort locations. And that plays a role in some of those resorts in 2026. Now let's talk about the World Cup a little bit. So this is an unprecedented World Cup. It's stretched across 16 cities, 3 countries. There's almost 5,000 kilometers between cities. For comparison purposes, in 2022, there were 55 kilometers between stadiums. That's it. But there's also 104 matches played, so an increase from, I believe, 62. So we are talking a massive expansion in the tournament, which I think is exciting and creates a lot of opportunity. But what I think is really, really important for people to understand is how the tournament plays out. It's not like you've got a match every day. In a lot of these cities, you have a match and then you have another match for 5 to 7 days. So if you're an international traveler and you're sitting there saying, "Hey, hypothetically, I'm a big Italy football fan, and Italy's playing in Kansas City. Great. I'm going to go to Kansas City. There's no doubt. I'm going to get on a plane. I'm going to fly to Atlanta, connect from Atlanta to Kansas City, or fly to Dallas, Dallas to Kansas City, or New York, or wherever you need to connect through to get to Kansas City. You get to Kansas City, you see your match. Now, are you going to stay in Kansas City for 5+ days? Not like you ever wanted to go to Kansas City before. Kansas City doesn't generate a lot of international tourism demand. The answer is probably no. You're going to then get on a plane or a train and go somewhere else. The reality is the real strength across this market is going to be tied to those cities that have a lot of international tourism appeal. So think New York, Los Angeles, Miami, and those that have great matches, and or great airlift, like Atlanta and Dallas, who are both hosting semifinals and both have great airlift, international airlift. And Dallas also is the media hub. So we think those are the markets that will be the real big winners. The markets like Kansas City, Philadelphia, Boston, Houston, we're less confident are going to have a big tailwind. There'll be something marginal, don't get me wrong. I'm not saying it's going to be nothing, but it's a little more challenging. And then the West Coast, San Francisco and in Seattle, we think it's going to be really relying on which teams get the draw to be in those cities, which is also less clear. Um, and then I'd be remiss if I didn't mention, some of the things we talked about before with geopolitical and consumer sentiment headwinds, the rhetoric coming out of the current administration, may limit some of the tailwinds, but we think the tailwinds are still going to be there nonetheless. We also think people get more and more numb to some of that rhetoric, and that'll fade, and we'll see some strength. To give you some perspective, we looked at Russia as a comparison. Russia in 2018, we think, is the best benchmark. It was the World Cup there was spread across 12 cities, 2,300 kilometer separation between them. Now, the challenge with Russia is it's a much smaller hotel market than the US and a much smaller international tourism destination than the US. So it's not the best comparison, but net, if you look across US, Moscow saw exceptional performance. St. Petersburg did not. And most other markets, did okay, nothing great. Um, but overall, Russia, we think, saw a lift of about 7 percentage points in annual RevPAR tied to the World Cup alone. Now, unfortunately, because Russia is such a smaller hotel market than the US, that 7 percentage points would translate to about 0.2% for the US in 2024. So it's not a big number. We think it's going to be much bigger than that because the US is more tourism oriented. But again, we estimate that it's going to be more tied to those New York, LA, Miami, Atlanta, Dallas, and less so in Kansas City, Boston, Philly, Houston, etc. And that does get incorporated into all of our forecasts. And then the dollar is also falling, which should help things. The dollar is expected to continue to decline, really all the way into 2027, which, as I mentioned before, will create some tailwinds for foreign inbound travel to the US and headwinds for US travelers to go abroad. And then we have upside and downside scenarios. So in our upside scenario forecast, this assumes that the effective tariff rate, rises to close to 15%, but then pulls back to 3%. So you don't see that permanent. Also points to a lot of other macroeconomic conditions that are a little bit more positive. In general, Moody's believes the macro backdrop for this forecast, there is a 75% probability that we will not hit that macro backdrop, that this is too aggressive. But even in that environment, there's still a 25% probability that we will. And that points to improving RevPAR in the back half of this year and really robust RevPAR growth in 2026. Flip side is if we take a look at our downside scenario, again, here there's a dynamic where there's a 75% probability that the US will exceed these macroeconomic forecasts that drive this model. And that points to RevPAR growth continuing to erode through the remainder of this year and remaining pretty soft next year, down 2.6%. Again, these are not our baseline forecasts. We're just highlighting what the potential outcomes could be based on all the moving pieces that we see across the macro environment. Couple of things I'll highlight about our forecasts on the top line is number one is our approach is better data in equals better data out. I think we're the only forecaster that incorporates citywide pacing data from the local CVBs, getting that convention data. We think that's really important. The only ones using Moody's Analytics as an economist. We think that's really, really important as well. And then we do a ton of work on our own on supply as opposed to taking some of the work done by some of the other third parties, which we think is suboptimal. And that's translated over the years into better forecasts. So if you look at what was our forecast for RevPAR growth going into 2024 versus actual results for the year, we missed RevPAR by 0.6%. Everybody else missed by 1 to 2.2. So fortunately, we did actually perform pretty well last year. And last year was not an anomaly. In 2021, we were the most accurate. 2022, we were the most accurate. In 2023, we were not the most accurate. We give the gold medal to PricewaterhouseCoopers. Abby Jane, Warren Marr, and that team. Warren's no longer there, but still think about them. Where they had, they were the only forecast within 1% of OCC, ADR, and RevPAR for the U.S. Only us and them were within 1% of occupancy and ADR. Again, they were the best for 2023. At a market level, this is the 62 markets that we track compared to the other guys. We are the most accurate. We were the most accurate in 70% of our markets last year, and by a wide margin. And most importantly, there are a handful of markets where they missed RevPAR growth by over 5 percentage points more than we did. It's a pretty big miss, and we see that time and time again. There's always going to be some big misses because you have some natural disaster or something that was unforeseen that you can't forecast. But outside of those things where we didn't miss by that much and they did, it kind of speaks volumes. And then for those of you that are in the investment world and you're looking beyond 1 year out, well, look 2 years out, look 3 years out. Again, we continue to be the most accurate across our markets and feel really good about our track record there. And our clients love it, fortunately. Now moving beyond top line, let's talk about bottom line. I want to mention labor costs before we get into the market coverage real quickly. So labor is a major issue. We are seeing it across the board here. This talks about just the union agreements, the challenges that we're seeing from union labor. And believe me, it does not just affect the union hotels, it affects all the hotels in the market. So this is something to be really mindful of. And then when you look at political risks, obviously we have in New York, the Safe Hotels Act that impacted things earlier this year. We think that continues to be a challenge for New York, basically forcing unionization for all hotels, 60 rooms or more. In LA, I think everybody's pretty aware of the minimum wage increase. What people aren't aware of is the exact same bill is going through the San Diego City Council right now, where it's passed committee with unanimous approval, and I think is coming up for City Council vote in November. So if you think these types of political risks aren't spreading to other cities, you're mistaken. They are. Be mindful of it. It's a real risk from a cost perspective. And then overall, we generally think wage growth is going to grow at a 2.8% CAGR. It's not, that's come down from where we were a few months ago. And the big reason for that is that jobs market has changed dramatically, and that creates a little bit more opportunity to not put where wages won't increase quite as much nationally as we may have thought before. Property taxes are going to continue to increase. Overall, we see expenses growing. They're not growing tremendously, but they are growing in an environment where RevPAR is really muted. That translates into negative hotel EBITDA growth through 2027 before we start to see growth in 28 and 29. And here's our cap rate forecast, similar to what we saw for ADR and RevPAR. And when you put it all together, if you look at our outlook for 2025, that has moderated considerably. We expect EBITDA to decline pretty meaningfully nationally this year. They're really driven by soft RevPAR growth and expenses that continue to move up, and that's going to pressure hotel values. If you look out over the course of 5 years, what we can tell you is that we expect RevPAR to increase at a nominal basis, about 1.1%. That's not enough to offset wage growth, so EBITDA will decline. But the good news is, like I just showed you, EBITDA growth will improve in the later years of our forecast, and that will drive values to increase as the outlook for cash flow growth improves towards years 4 and 5, which leads us to a modest increase in values over a 5-year hold period by the end of that 5 years. If you look at how our forecast changed from last quarter to this quarter, it was a pretty big move downward. And again, that's largely driven by the macro backdrop that is tied to the jobs market that we really walked through earlier in tremendous detail. Let's talk about markets real quickly. These are the 62 markets we issue quarterly forecasts for. For 2025, this shouldn't be too surprising. This 2025 data has a considerable amount of the year already built into it, while with the remainder still under forecast. But strongest growth is in markets with outsized economic growth like Palm Beach, which is going through massive shifts. We love that market, as well as great convention paces, San Francisco, St. Louis, Columbus, Orlando. St. Louis actually had a great second quarter tied to the convention calendar, something that we don't expect them to repeat next year, unfortunately. Bottom performers in 2025, they are urban markets with outsized leisure demand to a large extent. Memphis, Louisville, Nashville, Vegas, Portland, Maine. Those with soft group booking paces. Austin with the convention center under the knife. Las Vegas, soft convention calendar. Cincinnati convention center on renovation. And then difficult comps. Houston, we talked about the displaced demand levels last year in Houston. If you look to 2026, Maui has a lot of strength. That's tied to the idea that you're seeing recovery from wildfires as that market tries to get back to trend line. It's going to take years for that to happen, but we see meaningful uplift in Maui next year. San Francisco has a really soft base, obviously, in terms of recovery, so we still should see that. Miami benefits from the World Cup, which should help them. San Antonio has, San Antonio is effectively a very stable market. So in an environment where you've got kind of muted economic growth, those stable markets tend to perform relatively well. LA's got a great special events calendar. So does New York. LA's got the Super Bowl and the World Cup. New York has the World Cup finals. And then on the flip side, and then Raleigh's a market we also really like from a macro perspective. Convention Center calendar is looking great. Got some good things going on economically as well. Bottom performers, weakest growth is in markets with sluggish economic growth, Cincinnati and Pittsburgh. Pittsburgh's facing a lot of challenges tied to research funding to the universities there. That really impacts the economic activity across that market. We've got soft group booking paces. Pittsburgh also has some tough comps in May tied to storm that displaced 400,000 residents. It lost power for 5 nights. That created a huge boom in the second quarter, and that will face a pretty tough comp next year for Pittsburgh. Soft group booking paces in Austin with the convention center closing, Cincinnati as well, and then Ann Arbor and Charlotte just face some really tough comps. In 2026, if we take a longer term view, look out 5 years, you'll see top performers either have really soft comps, Maui, Orlando, San Francisco. Orlando, we also think Epic Universe is going to be a big tailwind, or they're going through major shifts. Palm Beach shifting that economic drive and getting a lot more corporate transient demand. Raleigh's booming as well, or those with generally strong economic trends, Miami, San Antonio, special events calendars like LA, and robust convention calendars. And then the bottom performers tend to be those with sluggish economic growth, Cincinnati, Louisville, Pittsburgh, KC. KC will benefit a little bit from the World Cup, but that's a one-time basis. So over the next 5 years, it doesn't really help things. Soft convention calendars, Austin and Dallas, with the convention centers under the knife. And then Houston has really tough comps. And then if we look at things from a value perspective, we love Orlando. We just talked about Epic Universe, the strength from the top line. Orlando will see, the Florida markets won't have the same benefit from low wages as they normally do because of the immigration dynamics, but still not overly bad. And we think that's really attractive. You'll see 3 of the top 5 markets in value are all in Florida. What you will notice is all of the top 6 markets across our value, our investment perspective, all are low wage growth environments. And that's really positive. New Orleans is probably one where we're more out of consensus than others. The convention calendar looks good next year. We know this is a tough year in New Orleans. We fully expect that. We built that into our numbers, but we feel really good about the convention calendar. We really like the convention entertainment district over the long term. I think that's a market that will work really well. And then Puerto Rico is going through massive shifts with the new energy grid, with the U.S. federal government investing $30 billion across that island. We think that's going to transform that market over time and make that a really attractive investment opportunity. Bottom performers tend to be soft convention calendars. Austin and Dallas face huge challenges on the top line. It's going to weigh on those markets. Elevated expense growth, New York, Chicago. New York is one that we don't really understand the investment community right now. We see so many red flags to bottom line and value over the next 5 years. There's great tailwinds on the top line, but you've got a new union contract coming up later this year, and that new union is negotiating from a position of strength. Positive fundamentals over the past couple of years, the World Cup coming in, and what looks to be a socialist mayor. I'm not sure I want to step into that. Just faces a lot of challenges when you move past some of those top line positives. And then St. Louis has challenged economic growth and going to face some difficult comps after 2025. With that, those of you that don't know much about LARC, we have 3 core verticals. We issue quarterly reports on 62 markets. You can purchase those on our website. Reach out to us if you want to subscribe to them. We have a LARC GIS application, which is super cool. You can basically select a hotel, draw, or a development site, draw an area around it, extract all kinds of data tied to that area, including what RevPAR is today and where it's going to be annually over the next 5 years. Great insights for developers, great insights for brands, for operators, etc. I certainly encourage you to learn more about it if it interests you. just reach out to us. And then advisory services, we do a lot of that as well. With that, I'm going to stop and take questions while Katie's populating those questions, and just highlight that if you do want to purchase any of our off-the-shelf market intelligence reports that we kind of walk through a little bit throughout this presentation, you can just go to that website right there, larkanalytics.com/shop, and you can purchase those reports literally just through your credit card, and then you can download it right after that. And with that, I'll stop and start to take questions. Katie, how are we doing?
Alrighty, we have 13 questions right
Great.
now, so I'm just gonna get going. What is your opinion on the extended stay segment? More specifically, the lower chain scale. Thank you.
Yeah, it's a great question. So, the extended stay segment tends to be driven by quote life events, true extended stay, where you've got people moving, net migration trends become a big component, or marriage, divorce, all those types of things can play a role in graduation in extended stay. We think that's all somewhat relevant, and those things will continue to drive demand to that segment. We think the segment is getting built up pretty aggressively right now, and that's not necessarily a bad thing. But I think that you got to be really careful, because take a look at the particular product, because a lot of quote extended stay hotels, residence inns, town place suites, homewoods, Hyatt House, etc. Their typical length of stay is 2 to 3 nights. They're effectively transient hotels. They're not extended stay. Then you get into a different component of the WoodSprings of the world, or WaterWalk or Stay App, and those are true extended stay product. We think that a true extended stay product has a lot of legs and can perform really well, but it is much more operationally intensive than the transient hotel, because it requires a lot of sales and local accounts, than the transient hotel that is really reliant on kind of the brand feed. So it really depends on what you're focused on. But we think that there's a lot of legs for that lower end extended stay, just based on the trends that we see across the economy. But, there's a big difference between, the big brands extended stay, which aren't so much extended stay, and then the true extended stay.
There's a few questions I think you've addressed, so I'm gonna skip for now. If we have time, I'll come back to them.
Mhm.
But do you think it will materialize even if tariff is 15% average for all countries compared to 2% previously?
Do I think what will materialize?
I'm assuming maybe the recession, but they didn't
Uh, yeah, I
specify.
think the,
So
the the assumption from Moody's is that tariffs will stabilize around 15%. I think 14.8 to be exact, and that does not translate into a recession. To the extent tariffs are worse, we could see a recession. To the extent they're better, we're less likely to see a recession.
can you provide additional information on 2026 convention pace? Are there stats by market on how convention pace is performing year over year?
We have those stats and we share it with our subscribers. Feel free to reach out if you're interested in subscribing and getting more data.
Many experts say 2025 is tough, but 2026 will be fine. Is there any basis for this? Please go through at some point, or is it all just hoping for the best?
I don't think 2026 is going to be fine. Hopefully, we touched upon it, but I think at the end of the day, our forecast for 2026 is RevPAR growth is up 1%, but that includes almost 2 percentage points of tailwinds tied to the World Cup. And those tailwinds are almost exclusive to New York, Los Angeles, Miami, Dallas, Atlanta. You get a little bit of tailwind for a handful of other markets, but if you're not in one of those markets that's benefiting from the World Cup, you're looking at more like -1%, which is frankly slightly worse than what we're seeing across the US in 2025. So we don't have the view that 2026 is going to be better. We just have the view that it's going to be better in certain markets.
Thanks for the presentation as always. LARC's forecast for New York is roughly 1 to 2% down year over year. CoStar, for example, is up almost 10% year over year for 2026. Obviously, you can't comment on another firm's methods or reasoning, but it seems like a huge change in opinions. Curious if you have any sense for why that could be. What's driving the negativity around New York RevPAR growth from LARC?
I think that our concern is what we're seeing across the macro backdrop and the economy. I think that's first and foremost. We're also seeing it from a foreign travel perspective. We think the tailwind for New York is going to be tied to the World Cup in 2026, which will be positive. But it's, unfortunately, outside of that, we just see a lot of headwinds. And again, like I mentioned before, our real concerns tied to New York are not on the top line, they're on the bottom line. Wage growth, we think, is a huge, huge concern. Political risk is a huge, huge concern. We don't know what's going to happen. If the New York has a socialist mayor, there's all kinds of talk about companies saying they're going to leave. Whether they actually do or not is a different story. But it's a real risk.
If there is so much time between World Cup matches, why won't international demand be spread out across non-host city markets? Is
I
there a good
think
chance to see broad-based demand across markets that are traditionally sources of international demand, national parks, DC resort markets, etc.?
In short, yes, I think that's 100% true. So our general view, I was speaking at the Choose Chicago Symposium earlier this week, and my advice to the hoteliers in the room was once you get a list of which countries are playing in Kansas City, they should be your target markets for trying to get some international demand next summer surrounding the World Cup, because you're spot on that. I'm not saying that those travelers won't come or will only come for one night. They just may only stay in Kansas City for one night. Or from a DC perspective, if your team is playing in Philadelphia, why not just stay in DC, hop on the train up to for the match and come back? It's a 2-hour train ride. It's nothing. It's really easy. I think you're going to see the demand, be stronger in some of those markets, 100%. So don't get me wrong. I do think those are tailwinds for those markets. I think in most of those markets, it's more on the margin than a huge driver, right? It's a good thing. It's just not a great thing. Um, whereas in New York, Atlanta, Dallas, LA, Miami, we think it's a great thing. Hopefully that's helpful.
In Russia World Cup, was it true that international visitors visited major cities and did not stay longer in less major cities? Does the data show that?
Yes, the data shows that. That's why we see, but it's not just major cities, it was really Moscow. Moscow saw close to 200% RevPAR growth during the 3 weeks of the World Cup. St. Petersburg didn't see much, didn't see anything at all, which is also a major city. So I think it kind of points to, but where's the airlift? International tourism, all those types of things are the big drivers. The regional markets didn't see much. Saw a little bit, but nothing crazy.
Hi Ryan, the LARC RevPAR model has had a historical R-square correlation of 98.8%. You mentioned the decoupling of GDP since 2021. How has that affected the accuracy of LARC's model? What is the historical correlation R squared of the model between 2021 and 2024?
Sure. So the way to think about the model is updated quarterly based on data that we have at that point in time. Just like you want to make decisions based on all the available information you have at that point in time. This is our current forecast model. That forecast model has evolved over time. It is not the exact same model as we saw in 2021 or 2022, but it is highly accurate based on what we've seen to date. GDP is a component of it. It has always been a component of it. It is not the primary component of it. We take a look at, the various different demand segments and look at factors that drive each one of them to incorporate into our models. So for corporate demand, corporate profits become a huge component. Unemployment rate is very relevant. For leisure demand, foreign exchange rates, U.S. personal savings rate, consumer confidence is relevant. Inflation comes into play, and then we're taking into account supply and convention pacing as well. All of those things play a role. It's not isolated to GDP, and we do not encourage anybody to isolate things specific to one variable like GDP.
Higher end chains are doing well, but economy chains are struggling. Is it true going forward and why?
Yeah, we kind of walked through our price class outlook, where our general view is that you're going to continue to see the high end outperforming. A lot of that is tied to the group segment, which is much stronger than the corporate or leisure segments. Leisure, with the U.S. consumer being particularly soft right now, especially in the middle class. If you've got a job market that's really, really soft, you have less disposable income. That is showing up in the U.S. consumer, which is soft. And what's kind of interesting about that is if you're, I always say there's a bifurcation between the haves and the have-nots in the U.S. consumer. The haves own a home, it's got a lot of equity, they're feeling pretty good about it. They may not be able to sell right now, but they're not losing money. They also have a lot of investments in the stock market, right? And their stocks continue to set all-time highs, right? I think last I saw, the stock market was up 600 points today. So we're seeing, but unfortunately, that's not the middle class and below that tend to stay at the lower tiered hotels, right? They're the ones living paycheck to paycheck and have credit card debt and and are reliant on increased wages and trying to grow their disposable income. And unfortunately, wage growth is slowing, and um, getting a new job is getting harder and harder. If you're unemployed, you're likely to stay unemployed because nobody's hiring. None of that bodes well to that lower end segments, which is why we generally see they will continue to underperform,
Which
at least through
emerging
next year.
hotel, sorry.
Yeah, just at least through
Wh-
next year.
Which emerging hotel brands do you believe will become core power players of the future? An example, Tempo by Hilton, Apartments by Bonvoy, Spark, Hyatt Studios.
I wish I could tell you I'm a brand expert. The answer I would give you is that when was the last time you saw a Spark commercial? Or a Homewood Suites commercial, or a Home Two Suites commercial, or an Embassy Suites commercial, or a DoubleTree commercial, or a Hilton commercial, or a Conrad commercial. Probably it's been a long time, right? When was the last time you saw a Hilton Honors commercial, or a Marriott Bonvoy commercial, or a Choice Privileges commercial, right? Um, at the end of the day, the big brands, the big brand families claim to have, 20, 30 brands, et cetera. But the reality is, from a consumer perspective, they have one. It is their loyalty program, right? It doesn't matter which brand you have. The brand is all about, from a consumer perspective, the brand is the loyalty program. And as long as you're part of that loyalty program, that's what drives that demand. It's not whether you're a Spark or a Tempo or a Embassy or a DoubleTree, right? That's not what's driving it. It's the loyalty program. And obviously there are components. Hey, this brand is cheaper to build or easier to convert or has better cost structure. Don't get me wrong, from an operational perspective, there are reasons why some brands will proliferate more than others. But from the consumer perspective, it's all about the loyalty program. And the only reason they have 30 or 40 different brands is so that they can circumvent the territoriality restrictions that the real estate owners have.
Given the return of group and convention demand to record levels and the U.S. hosting mega global events such as the World Cup and Olympics, do you view airport hotels in major markets as moving into a favored premium investment category?
No, unfortunately not. Nobody wants to stay at an airport hotel. They stay there because they need to. You don't have the corporate travel dynamic has dropped dramatically. They're the ones that stayed in airport hotels a lot because it was easier to catch that early flight as a road warrior to go to the next place you were going. That's had an impact. Leisure travelers don't want to be there nearly as much. So we don't see airport being a primary strength going forward. In fact, obviously airport's down among the most this year. We expect it to be down among the most next year.
With Austin's convention center closed for redevelopment until 2028, but more than 10 billion in diversified projects underway, do you see the city reemerging as one of the nation's leading boom towns once the convention center reopens after 2029?
Yes, eventually, but the question I would ask you is, can you point to a single multi-billion-dollar public infrastructure project that was on time? So do you think it's going to be 2029 or could it be 2032? And your time horizon matters. We think you still got a couple of years before it makes sense to start investing in Austin.
This one's just a compliment. How come you're not on CNBC? Great job.
Thanks.
And
Been on it
then,
before.
what's driving New York's increase in quarter one, 2026?
I don't know if we walk through the details of New York by quarter here. But feel free to circle up with me offline and we can walk you through details. I'm assuming you're a client and happy to help.
Are you surprised by the recent drop-off in Las Vegas?
Yes and no. So Vegas is a market we really like over the long term. The convention calendar is really soft this year, and that's certainly playing a role. But we are also seeing softness in terms of domestic leisure demand, which also is another big component of Vegas. I mean, I can tell you. Um, So when you put that together, no, it doesn't surprise me. The flip side of that is, look, going into this year, we felt really good about where leisure demand was going to be in 2026. The back half of last year, we were seeing all the economic data points were pointing to a much stronger U.S. consumer in 2026, in 2025, and and leisure demand picking up and throughout the year. And then the quote tariff tantrum happened and things changed dramatically. And economic growth slowed dramatically, and you've seen the outlook for the hotel industry dissipate gradually throughout the course of the year from where we were at year end. So I would say if you go back to where our views were in December of last year, yeah, we felt pretty good about leisure. We knew Deep Vegas had some challenges tied to a difficult convention calendar this year, but we felt good that leisure was going to be okay. And then leisure fell off a cliff too, and that played a role. But long term, we think Vegas is going to be great.
Speaking of loyalty programs, do you think point devaluations in the hotel and airline market will ever stop as it hurts the middle-class travelers during a tougher economy?
I highly doubt it will stop because I think most of the people that it impacts, they don't even realize that it's impacting them.
We have another market-specific question. Why so bullish on Antonio's RevPAR growth in 2026 when in 2025 convention calendar was stronger and they had the Final Four?
So I wouldn't say we're bullish on the San Antonio in 2026. It's just that we're less bearish, and a lot of that is tied to a very stable economic environment based on the mix of metrics, demand drivers across the San Antonio market. Um, and that kind of leads to an outlook that is less negative than we see across a lot of other markets.
When normalizing LA 2026 for 2025 fires and 2026 events, is the market actually down?
Mm. It's hard to kind of quantify the true impact of those fires. We don't think the market would be down when normalizing for those factors because in 2026 you're seeing real strength tied to, or are you saying maybe in 2025 would it have not been down? Mm, Yeah, it's possible that it wouldn't have been down in 2025 without the impact of the wildfires, but we haven't tried to quantify the specific details of them. But in 2026, we think the market's going to be up, tied to the Super Bowl as well as the World Cup.
They just responded and said no, they're referring to 2026
The
for that
impact for the
question.
wildfires in 2026. Well, the wildfires haven't impacted 2026, so I'm not sure how they would, but I think that you're going to see tailwinds tied to the Super Bowl and the World Cup, so we'll see strength in 26.
If the stock market goes down significantly, will it start affecting higher end hotels as well as it will affect their pockets?
You have to assume it would. I mean, but for the stock market to go, I mean, doesn't, it's not our baseline assumption that the stock market's going to crash. Don't get me wrong. We think that we're living in a bubble right now, but there's no end of that bubble in sight.
Do you think credit card, and this is the last question for right now, do you think credit card loyalty and points hacks will ever outweigh brand loyalty?
I would say not for the heavy traveler, the heavy corporate traveler, the road warrior that is traveling, 50 nights a year away from their family and wants to take their family away to the Ritz-Carlton or the Waldorf Astoria for a week's long free vacation.
And that's all the questions.
Great. Well,
Oh,
thank you all for
we
joining. I appreciate you all joining for the webinar. Hopefully you found the information helpful. Like I said, feel free to reach out to us if we can be helpful going forward. And we'd love to get you on board with the LARC platform if you have any interest. Thanks so much. And I'm going to stop the share. And I hope everybody has a great day. Thank you all for your time.